Most of us think risk management starts after they enter the trade. It doesn't. It starts before the trade even exists. Because the moment you click buy or sell, the market is already capable of doing something you didn't expect. And that's the uncomfortable part. You can spend hours studying charts, indicators, news, price action, and still be wrong. Not because you're careless, because markets are uncertain by nature. That realization changes something important. You stop asking, how much can I make from this trade? And you start asking, how much damage can this trade do if I'm wrong? That's a very different trader. Risk is the first decision, not the last. Most beginners don't think like this. They focus on conviction, confidence, accuracy. They increase size when a setup looks strong. They risk more after a winning streak. Sometimes they even move stop losses because they know the market will come back. And slowly, without realizing it, they create emotional position sizing, not structured position sizing. There's a difference. One is based on process, the other is based on feeling. And feelings change every day. That's why many trading accounts don't collapse instantly. They erode slowly. One oversized loss, then another, then revenge trading, then hesitation, then fear of pulling the trigger. Not because the strategy completely failed, because risk governance failed. The market is unpredictable, but exposure is not. That's the part traders often miss. You cannot fully control market direction, volatility, news events, or sudden liquidity shifts. But you can control three things completely: your position size, your stop loss, and the percentage of capital exposed on a single trade. That's it. Those three variables quietly decide whether you survive long enough to become consistent. And this is where the 1% rule comes in. The idea is simple. On a single trade, you never risk more than 1% of your total trading capital. Not 1% investment, 1% risk. Very important difference. If your account is 1 lakh rupees, your maximum loss on one trade should be around 1000 rupees, not more. Because the purpose of the rule is not to grow fast, it's to prevent one emotional mistake from causing structural account damage. Here is a simple framework. You start with defining risk, stop loss, and then position sizing. Most traders reverse this process. They decide position size first, then adjust risk emotionally afterward. Structured traders do the opposite. They first decide, how much am I willing to lose if this idea fails? Then position size becomes a calculation, not an emotion. That shift matters more than people think. Because once risk becomes predefined, fear changes. Now you're no longer watching every candle like your future depends on it. You already accepted the loss before entering. That creates psychological stability. And stability improves execution, not prediction, execution. There's another important truth here. The 1% rule only works if your capital size is realistic relative to market volatility. A lot of beginners misunderstand this. If the capital is extremely small, sometimes proper stop losses and proper position sizing become mathematically difficult. Then traders start forcing leverage, tightening stops unnaturally, or taking oversized exposure just to make meaningful profits. That usually creates gambling behavior disguised as ambition. The market does not care about our urgency. It only responds to structure. And honestly, the 1% rule is less about mathematics, more about identity. It reveals what kind of trader you are becoming. An emotional trader wants fast account expansion. A structured trader wants survival first. Because survival creates repetition. Repetition creates data. Data creates refinement. And refinement eventually creates consistency. Most traders try to skip directly to consistency without building the structure that supports it. That's why they experience random emotional cycles. 1 week confident, 1 week fearful, one loss away from changing strategy again. But when risk is controlled consistently, something strange happens. Trading becomes quieter, less dramatic, less addictive, and actually more professional. So before your next trade, don't start with the chart. Start with the risk. Ask yourself, if this trade fails completely, does the loss still respect my structure? If the answer is no, the trade is already too big. And maybe tonight, open your trading journal and review your last 20 trades. Not the profits, not the setups, just the risk taken on each trade. You may discover that your biggest problem was never strategy, it was exposure.